Hello, this is Randy Alsman from Donaldson Capital Management. I'm going to provide you a few of the key takeaways from our Investment Policy Committee meeting today, Monday, June 25th. A few weeks back, Business Week had a magazine cover that seems more and more appropriate every day. It had a big black circle in the middle of an orange cover, and in big white letters in the middle it said, "For relief from the European crisis, bang your head here." And it certainly seems that there's a lot of head banging going on, not just in Europe, but all over as a result of the European crisis. Our market closed down today, the S&P 500, by about 1.6%, entirely due to concerns about Europe's ability to find a solution. The concerns of the growing problem and the growing inability of 17 nations with a monetary union but without a fiscal union to find a solution is causing even German bonds now to be called into somewhat of a question. Certainly their yields are very low. They're still considered very safe. Germany still has a very strong financial situation, but the relative movement is telling that even Germany now is beginning to suffer a little bit with the doubts of their ability to hold up an entire continent as the dysfunction seems to spread. That is a little bit more dire view of it maybe than is appropriate, but I have to tell you that all of us on the investment committee today were feeling more pessimistic about Europe than ever before. It just doesn't seem like there's a way out of the box for them without giving up sovereignty, and they won't give up sovereignty, and that is sort of the catch-22 that the continent finds itself in. We also are seeing the power centers shift a little bit or become a little less clear. It seemed at the beginning it was Germany versus the periphery, Germany versus Greece and Italy and maybe Spain, certainly Ireland and Portugal, the very strong northern country versus the weaker southern countries. But lately it's beginning to seem like the struggle is shifting to Germany versus France. Germany depends a great deal on Europe for their economic growth and their GDP. I think over 40% of their exports, and Germany is an export-driven country, over 40% of their exports go to the European Union. With France, it's much less that way. They are much less dependent on exports to Europe for that. Plus, France is not as big a creditor to the European Union countries as Germany is. You think about the old saying that if you borrow money from a bank, then the bank owns you, but if you borrow a huge amount of money from the bank, you own the bank. Well, increasingly, Germany sees that its options are becoming limited by the fact that so many of the weaker countries have sold their bonds to Germany, or said the other way, Germany has purchased their bonds, which puts Germany at great risk if those countries were unable to repay them or had some other defect in their ability to make good on their debts. So as these tugs and pulls go back and forth, it continues to drag the economies, the collective economies of the European Union south, and that has an inevitable effect on emerging markets such as China, whose biggest export market is Europe, and the U.S., where 20% or so of our exports go to Europe. So the longer this continues, the more pessimistic we at Donaldson Capital Management became that we would see a snapback in the second half of the year in U.S. and global GDP. Actually, snapback overstates it. We didn't expect a dramatic rise, but we did expect it to improve in the second half versus the first half. We no longer believe that that rise in the second half will be dramatic, and it may be flat. We are holding so far to our outlook for the year of mid to high single digits for earnings per share growth on the major companies in the S&P 500, and therefore we believe that the S&P 500 itself has the opportunity to grow at that same level. However, we all know the risks that it faces from headlines. We've got the European crisis we just talked about, also the fiscal cliff that I think everyone has heard about so far, and the ending of the Federal Reserve's Operation Twist, now extended to 12/31, provides yet another stimulus action that ends on December 31st, the end of the year. So more and more we're seeing that many of the dynamics are being pushed into the future. The resolution of some of these issues is being pushed into the future, and the farther into the future they get, the more difficult they are to resolve. As a result, we are beginning to shift the portfolio even more defensively. The nature of our companies and a rising dividend strategy is defensive in itself, but we can tweak it so that it becomes a bit more aggressive or a bit less aggressive as economic conditions warrant. And right now we're feeling a little bit more on the defensive side, and we'll probably be taking a few steps in that direction. If any of you read Greg's blog from last week, you'll remember some of the charts that he did, and we'll flash a few of them up here, where companies with the higher yields performed better. It turns out that companies that are higher credit rated companies, the AA and AAA companies, outperformed the lower credit rated companies. We also saw that the larger companies had a significantly better earnings performance in the last year or so than the smaller companies did, and certainly therefore we believe that quality, yield, size, and even in the domestic U.S. markets, that being a U.S. domiciled company significantly seems to improve the performance of these companies' stocks on the stock market. We'll flash a chart up here as well that shows some of the key international stock markets compared to the U.S. and then the overall world average stock index. You'll see that the U.S. stock market has outperformed all the others. The U.S. is increasingly seen as a safe haven, and that goes for its stocks as well as for its treasury bonds. As a result, we feel very good about where our portfolio is positioned. We have been dialing back non-U.S. domiciled company exposure for over a year and a half now. We continue to look at that, and as I mentioned earlier in these comments, we'll probably be making the portfolio even a little bit more defensive in that we see no major change in either outlook for GDP growth or outlook for resolution of some of these issues before year end, given that this is a presidential election year. We have not yet heard about the Supreme Court ruling on the healthcare law. We think that could be a major headline effect. Don't know how long it would have an impact, but certainly some of the healthcare companies have done well as a result of that law. Therefore, if the Supreme Court nullifies that law or major portions of it, it will almost certainly have an effect on the healthcare sector. Don't know how big an effect, don't know how long it might last. A lot of that will depend upon the details of the Supreme Court's decision. So a lot to keep track of, a lot of headlines out there to continue stirring up the volatility. It does appear, however, that the market will continue to look toward those large, high-yielding, high-quality companies, and especially those companies demonstrating real growth. That summarizes our meeting for today. We see the outlook for global GDP growth slower than it has been up to now. Still growth, but slower, certainly. Our outlook for corporate earnings is now toward the lower end of our range of mid to high single digits, but still a decent growth rate. And we have seen some handsome dividend growth during 2012 so far and expect that to continue. More and more companies are realizing that dividend yield is being rewarded in the marketplace, and therefore that is encouraging more companies either to initiate a dividend or to raise their dividend at a higher rate than they might have otherwise. We will watch the economies and the politics around the world, continue to monitor our individual companies, looking for opportunities to trim or add new companies where profit-taking is appropriate or where opportunities present themselves, but with a more cautious and more defensive eye maybe than we've had up to now. That's all for today. Thank you for your time.